The sixth objective in Chapter 7 is to prepare a bank reconciliation and the related journal entries. Okay, so a bank reconciliation is taking the two records of a business's cash activity and comparing them to one another and then reconciling them. What two records does a business have for its cash? One is the cash account in the general ledger. Okay, we journalize transactions in the journal, and then we update the ledger accounts. So every time cash is debited or credited, we then journalize the transactions and post it in the cash account in the ledger. Okay, the second source of cash records would be the bank statements. It shows the receipts and payments that have gone through our cash account at the bank. We're going to have a different balance at the end of the period for the general ledger cash balance and the bank statement. Why? This is because of three things. Timing differences. We know that when we make a deposit at the bank, it might not show up in our account until the next business day. Some banks cut off their business transactions at 1 o'clock in the afternoon. Anything processed after 1 p.m. might not show up until the next business day. If it's a Friday, that means it might not show up till Monday. Also, we might have a difference because of outstanding checks and deposits. Okay? Outstanding checks are checks that we have sent out but have not been presented to the bank yet. Outstanding checks are checks that we've paid, but they have not been presented at the bank yet. An outstanding deposit is a deposit we make, but it hasn't shown up in our bank account. If it's the end of the month and we make a deposit on the 30th, it might not appear until the subsequent month's bank statement, maybe on the 1st, 2nd, 3rd, or something like that. And the third item that might cause a difference in balance would be electronic funds transactions, EFTs, electronic funds transactions. We could be receiving payments from one of our customers, or we could be sending out EFTs to one of our vendors. And these might not necessarily show up in the cash account, and we might not receive notification from the bank until the statement arrives in the next month. So what a bank reconciliation does is it tries to explain all the differences between the cash record on our books and what the bank record shows. Okay? And one of the important things about bank reconciliation is the preparer should have no other access or to cash or have any other cash handling responsibilities. Why? Because that way the preparer might have the opportunity to manipulate the records. So, the bank reconciliation has two sides. On the left side, you've got the bank side. The bank side starts off with the end of the month balance. Okay, it starts off with the end of the month balance, and that would be right here. So our balance at April 30th would be $14,070. The next item we add would be our deposits in transit. Deposits in transit are these deposits we've made at the bank, but they haven't ended up on the bank statement yet. And these are the example I gave earlier was transactions processed at the end of the month. So if we make a deposit on April 30th and it doesn't show up on the April statement, it's going to show up in early May. So we would add a deposit in transit. The next item, outstanding checks, would be checks that we've sent out but haven't yet been presented to the bank. So that's what this item is here, outstanding checks. Okay? If you make your payments at the end of the month to your vendors, they might not cash them for a week or two. So those items have not been removed from this balance as of yet. So what we do is we subtract our outstanding checks. And the fourth item on the bank side of the reconciliation would be errors. These are bank errors. Okay? Bank errors can either be added or they can be subtracted from the bank side of the reconciliation. Okay? So if they recorded a check in error, we have to correct for that. Or if they put someone else's deposit into our account, we would have to allow for that. So on the bank side, these are items that are not yet recorded. You would take your bank balance, you would add deposits in transit, you would subtract outstanding checks, and you would add or subtract bank errors depending upon which direction the error goes in order to bring the bank side into alignment. Next, we have the book side. Remember I said the bank reconciliation consisted of two things, the bank side and the book side. Bank side is on the left. The book side is on the right. These are items that are not yet recorded in the books. What would these include? Well, the first thing we would have is we would have our bank balance from the books in April. Okay? So we would pick up this $21,000 amount from our records. Now, everything we're going to add or subtract from the book side comes from the bank statement. Everything that gets added or subtracted to the book side is found on the bank statement. So we might have had on our bank statement an electronic fund transfer from a customer of $100. We probably earned interest revenue since March 30th of the year. So that's where the $30 comes from. We add receipts from customers that we hadn't recorded. We add interest revenue on the bank balance. Okay?